$1. So this is the rate at which the transaction will take place. So if you want to buy a unit of any currency, the price that you pay for that currency is the foreign exchange rate. So what I'm trying to say is that foreign exchange rate is also the price, and foreign currency is considered as a commodity, right? So any commodity you purchase, the price is generally determined based on demand and supply. Now, in general, if the demand goes up, the price goes up, right? And vice versa. Okay, so if the demand goes down, price also goes down. So if the supply goes up, keeping other thing constant, if the supply goes up and demand is constant, then the price goes down, right? And vice versa. So demand and supply generally influence the broader aspect of pricing. So any commodity that you are going to buy or sell, any commodity that you are going to buy or sell, the price of that commodity will be determined based on demand and supply. And now there is a condition here. What is the condition? The condition is that in order for demand and supply to fully reflect the price change, okay, in order for the demand and supply to fully reflect the price change, the market has to be near efficient. Remember efficient market, we said perfect market, efficient market, right? So in order for the demand and supply to work, the market has to be near efficient. So the price, the equilibrium price or the balance price that you are choosing, it has to be in an efficient market. So let's talk about how the price is determined, right? So the place where demand and supply intersect, that is what we call equilibrium price. That is the price that the buyer and the seller is ready to pay, right? This is the price at which you negotiate the product with the seller. As a buyer, you negotiate to buy the product from the seller. So equilibrium exchange rate also is the exchange rate, is the price at which you buy or sell foreign currency from the seller or buyer. And this is the rate that you set is the balance price, is the equilibrium price is also called the balance price. So there are a few terminologies I will write, and obviously, as I said, I will upload the file later, so you'll try to go through it. It will be easy for you, right? So equilibrium price is also called the balance price, right? This is the price at which both buyers and sellers agree to transact. Okay, so this is the price at which both buyer and seller will agree that we are going to have a transaction, and there will be matching in the market. And anything that is outside of this, equilibrium will shift. Okay, so if for example, if the demand curve can shift towards right, okay, if the demand curve shift towards right, the prices are going to be adjusting. The prices are going to go high. Let me make it a little bit bigger. So if also keeping other thing constant, the supply curve can also shift. So the supply curve, for example, can shift towards left, meaning that supply can reduce. If the supply reduces, price will automatically adjust, right? Price is increasing. So demand and supply, keeping other thing constant in an efficient market, can help you determine what should be the price of any commodity, or what should be the rate of foreign currency, right? Now, if we can identify what are the factors that determine supply and demand, we would be able to easily identify what are the factors that influence foreign currency rate. So what are these factors that in general identified in the past that influence demand and supply for foreign currency? First one is price, general price level, or inflation. Okay, inflation rate is the changes in general price level. So first factor is the price, or let's say the changes in price, changes in product price, any price that will help you to calculate inflation rate. So I will explain each of these separately. These are important aspects. Second one is cost of borrowing, which is interest rate. Okay, interest rate is also important determinant of foreign currency rate. Number third is national productivity or national income, which is, for example, GDP. Okay, your progress, national economic progress. Number fourth is speculations or expectations. Okay, what kind of expectation is going on in the market? What is the speculation, whether the market has any speculation or not? And other thing, government control is the number 50. Okay, so let me write few sentences about it. First one is changes in price. Okay, this is a general price level. Changes in price of general commodities. Okay, now any price level in the market changes are changes in price. Changes in price is reflected by inflation rate. So we can calculate what is the inflation rate in a country by taking the changes in price level, or we call it consumer price index, right? CPI. If the CPI changing too much, increasing, that means the inflation rate is increasing. But if the CPI is decreasing, we say that inflation rate is decreasing. Now, what is inflation rate? What is inflation? Inflation is generally considered as the reduction of price, reduction of purchasing power. Okay, inflation is generally considered as the reduction of purchasing power, meaning that whatever you could purchase with $100 last year, with 10% inflation rate, you need 10% extra money to buy the same thing. For example, last year, one shirt was $100. This year, inflation rate is 10%, for example. Okay, so this year you need $110. Okay, 10% extra, $110 to buy the same shirt. This is called inflation. So inflation is actually reducing your purchasing power. Your purchasing power previously was with $100, you could buy the same shirt, but this year you need $110, meaning that your purchasing power actually dropped by $10. So inflation rate basically reduces your purchasing power. Now, if the inflation rate reduces your purchasing power, now instead of considering shirt, let's consider for businesses. Okay, businesses that deals with currency. For example, you do, you are engaged in export and import. Okay, so if you do export and import, due to inflation rate, what you are, how you are suffered, you need to now have additional currency in order to pay your bill. For example, for importer, the amount to settle import payment will go up by the inflation rate, say 10% this year. Okay, so the amount of money that importer had to pay to the exporter this year, because of 10% inflation rate, the amount that you have to pay will increase, right? Increase by 10%. For example, import payment was, for example, $10,000. Due to 10% inflation, what will happen? It will increase another 10%, right? Due to 10% inflation, the import payment is now how much you are going to pay? 10,000. 10% is $1,000, so 11,000. You'll pay 11,000 instead of $10,000. So this is basically reducing a company's purchasing power, right? So that has an overall impact on the economy. So if you have reduced inflation rate, sorry, if you have reduced purchasing power, what is the impact on exchange rate? The currency that has higher inflation, currency that has higher inflation will devaluate. Okay, there are two terms that we will use. You can use devaluate, or some people also use, let me use a slash here. They use depreciate. Okay, so there are two terms that they use often for currency rate increase and decrease. One is depreciate. So the other one is the currency that has lower inflation. Okay, if you have lower inflation rate, will appreciate. Okay, so if your currency rate is, if your inflation rate is low, your currency will appreciate, meaning that your currency will be stronger. If your currency inflation rate is higher, meaning that your currency will depreciate. So it's an opposite connection because of the price that you are paying, right? So let me give you an example. Say we are considering two currencies, which is ringgit and Brunei dollar. So Brunei dollar 1, let's say current rate is Malaysian ringgit 3. Okay, this is the current rate. And you are expecting that, let's say there would be inflation rate. So let me okay, this is the currency rate. Okay, now the inflation rate. So let's say inflation in Brunei is 2% and inflation in Malaysia is 5%. Okay, this is a hypothetical figure. Now, because of additional inflation in Malaysia, just think about it, what will happen? In Malaysia now, because of extra inflation, 5%, additional 3% inflation, Malaysian currency will be expensive for the foreigners. Because in Malaysia, purchasing power, Malaysian currency purchasing power dropped, right? What you could buy previously with 3 ringgit, you need now 5% extra to buy the same thing. Therefore, Malaysian ringgit will lose its purchasing power. Now, if Malaysian ringgit loses its purchasing power, people will sell it. They will not buy it. So demand for Malaysian ringgit will drop, right? If the demand for Malaysian ringgit drop, at the same time, demand for Brunei ringgit will be up, because this is just two sides of the coin. This Brunei $1 and Malaysian ringgit 3. This is basically two sides of the same coin, right? So if Malaysian ringgit is from 3 to 4, for example, now the new rate is Malaysian ringgit 4. This is still Brunei dollar 1, right? So it is the same two sides of the same coin. Therefore, if Malaysian ringgit becomes 4 due to inflation rate 5%, that means Malaysian ringgit has depreciated. We call it depreciated. Meaning that you need more Malaysian ringgit. Depreciation means you need more Malaysian ringgit to buy the same dollar, same Brunei dollar. So let me write it here. Depreciation means we need extra of the same currency to buy another currency. So you need some extra. Previously you needed 3 ringgit, now you need 4 ringgit to buy the same currency value. So your purchasing power dropped, and any currency that has lesser purchasing power, okay, currency is money, right? So what you use the money for, you purchase. But if your currency value drops, your purchasing power drops, nobody will use your currency. Why people use US dollar? Because the US dollar purchasing power is very strong. Why people use euro or British pound sterling? Because the purchasing power of this currency is very strong. But if your purchasing power drops, people will not use your currency, because your currency's purchasing power dropped and you have to pay much more in order to buy the same foreign currency. You have to pay now extra 1 ringgit to buy the same Brunei dollar. So inflation rate is oppositely connected to the currency value. If the inflation rate increases, the currency or the country with higher inflation rate will most probably see their currency rate devaluating. their currency rate will lose purchasing power. So you understand now why inflation rate is important. And for Brunei, it is also very important because Brunei has to maintain similar inflation rate with Singapore. If Brunei inflation rate is very high compared to Singapore, the currency pledging agreement between Brunei dollar and Sing dollar will not hold. Okay, so Brunei has to have a very strong inflation rate management or price management. So this is number one factor. Second factor is interest rate. Okay, similar. Interest rate and inflation rate both has similar impact. So if your interest rate is high, meaning that fund is becoming very expensive in your country. So second factor is interest rate. Okay, if interest rate is high, fund for investment will be expensive, right? If in your country, interest rate is very high, meaning that the businesses, those are in your country, or let's say foreign businesses, those are in your country, they will face a lot of problem in terms of getting low cost fund because the borrowing rate is very high. So if the borrowing rate is high, what the investors will do? They will not borrow from your country. So if borrowing rate is high, demand for fund in that currency will drop, right? So people will not borrow from your country because your borrowing rate is high. Hence, demand for currency will drop, price will depreciate. Very simple, right? Price will depreciate too. So if the borrowing rate is high, investors will go to other countries. Foreign companies will go to other countries. They will look for a country that has lower interest rate. If the interest rate is low, they will borrow from that country. But if your interest rate is high, your currency will devaluate. And interest rate and inflation rate rates are positively connected. Okay, when we calculate interest rate K, for example, when we calculate K, there are a number of factors. K star is the risk-free rate of return plus IP. IP is the inflation rate. Then we have DRP, default risk premium. We have LP, liquidity premium, and we have MRP, maturity risk premium. We normally teach this thing in financial management. So previous course, I think you have already learned this thing. So when we are calculating interest rate K, one of the component is IP. IP is inflation premium. So inflation premium means the percentage of inflation in a country. So if your inflation rate is increasing, automatically your interest rate will increase. Okay, there is a direct connection between these two. So if the inflation rate devaluates your currency, interest rate will also devaluate your currency. Next one is national income. How your national income influences your currency value. Now, national income also represented by, for example, GDP growth. Okay, now GDP represents the production opportunity. Okay, GDP is the gross domestic product, right? Gross domestic products. So this is the value of total products in an economy at a specific price. So gross domestic product, what it indicates? It indicates if you have higher GDP, okay, GDP, meaning that the country helps to produce more. Okay, for example, China, very high GDP, meaning that what? China is the production house of the world, right? US, one of the highest GDPs in the world. Their economic growth is #1 in the world, meaning what? They have opportunities to produce more than others, right? So Germany, France, Japan, United Kingdom, Australia, Canada, these are the countries, Brazil, India, you know, these are the countries where you have higher GDP, meaning that these countries help you to produce more. Now, if a country produces more, what generally happen in a country where there are a lot of production going on? Okay, if GDP increases, demand for fund increases, right? In order to produce, you need fund. Okay, in order to produce, you need foreign funds, you need international funds. So the demand for that currency increases. If you want to produce in Brunei, for example, you need to invest in Brunei currency, right? You need to have Brunei currency, and then you have to invest in Brunei currency. So when you are asking for more funds, for example, a company from Malaysia, they want to invest in Brunei because Brunei GDP is increasing, for example. So if any foreign company comes to Brunei and invest in Brunei, what they have to do? If a company coming from Singapore, they will bring Singapore to Brunei, right? Singapore dollar to Brunei, and they will convert. They will convert to Brunei dollar and then invest in the local market, right? Say, for example, a businessman from Malaysia, if they want to come to Brunei and they want to invest in Brunei, what they have to do? They will bring Malaysian ringgit. Then they will convert, right? They will convert to Brunei dollar, and then they will invest in Brunei market. So when you are converting, if the GDP of your country is high, people will ask for more conversion. People will ask for your currency because there is a higher demand. So if the GDP increases, demand for fund also increases. Demand for your currency also increases, meaning that currency value will appreciate, right? So more economic growth, better economic growth, your currency value will appreciate. Your economic growth is lousy, it's not going anywhere. You are declining in terms of economic growth. Your economy has, for example, lots of trouble. There are lots of kind of sanction going on and other things. There is no real production going on. Your currency value will be completely wiped out. Yeah. So this is about national income. The next one is speculation. Expectation or speculation. Okay, speculation is a massive force. It's a sentimental force in the market, especially driven by big investors. Okay, now speculation means what? Someone is speculating, someone is targeting. Speculation also is synonymous with targeting. Someone is targeting your currency. Someone is targeting your currency to invest in your currency, for example. Say for example, a big investment company, let's say Apple, Apple, for example, Apple is suddenly declaring that we are going to invest in Brunei, $5 billion by next 5 years. Okay, so this will be kind of like, give me a moment, please. Someone is waiting. Okay, so anyone who is investing in your country, for example, Apple has declared that we are going to invest $5 billion in Brunei. What will happen? There will be a lot of interest, right? Because Apple is a big company. So there will be a lot of speculation. People will start to speculate with Brunei currency. And obviously, when Apple comes to Brunei, they will first convert US dollar to Brunei currency. That means they need a lot of Brunei currency, right? So if they are asking for a lot of Brunei currency, demand for Brunei currency will increase, and that will eventually push the price too high. Now, sometime, if which part of this is actually speculation? If Apple is actually investing in Brunei market, that's not speculation. That's only an investment. Okay, that goes into GDP. But speculation is that there is suddenly a rumor in the market. Okay, that's what I said. It's a sentimental force. There is a rumor in the market that Apple is coming. Okay, Apple did not say anything yet, but there is a rumor going on that, well, Apple is going to invest in Brunei market for about $5 billion. This rumor, even though it is not true, it is going to force the price of Brunei currency to be higher. Okay, so sometimes this speculation is taken as a weapon. It is taken as a weapon by some speculators to move the market price towards certain direction. So speculation can move market prices towards certain direction. Okay, this is basically the rumors. This is basically non-fundamental information that influences market prices to go towards certain direction. So your currency value may appreciate, your currency value may depreciate, depending on the speculative information that you have in the market. Speculation must be controlled. Speculation must be controlled. Excessive speculation is bad for market. Sometimes speculation is good because speculation helps you to create a market, right? Speculation helps you to create a market. Without speculation, actually, there is no market. But too much of a speculation is bad. You know, too much of speculation is bad because of speculation, your expectation will be very high. If your expectation is very high and it's not supported by fundamental, then you are going to make a lot of loss. Okay. So what we consider speculation as, it's a force, it's a sentimental force that moves the currency value towards certain direction. Last one is government control. Okay, now government cannot directly control. Government cannot directly control in any market. Okay, government cannot directly control in any market, but government can indirectly control currency market, but for stability. So you can now, I think, realize that currency value is very sensitive, right? It's very sensitive for your economy. Increase in currency value, decrease in currency value can bring a lot of investors, can also push a lot of investors to other countries, right? So therefore, currency value is very, very important. So in order to stabilize, if your currency value is unstable, no one will come to your country. So companies, when they're investing in a country, they want stable currency value. That's why China has a fixed currency value. You see, that's why many investors go into China, because currency value is fixed. So even though fixed currency value, it has its disadvantages, but investors, when they're investing in a country, they want currency value to be stable. Now, to bring that stability to the market, government can indirectly control currency value. They can indirectly put their hidden hands into the market and try to control the price of the currency. So how the government can indirectly control? Government will buy or sell financial assets that influence the value of currency. So government will not directly influence the currency market. They are not going to directly buy currency itself. Okay, they will buy financial asset that is connected to the currency. Okay, so by buying or selling financial assets, they will make sure that currency value is stable. Okay, for example, if government of Brunei wants to strengthen BND against Malaysian ringgit. Okay, what is the objective? Government of Brunei wants to strengthen, appreciate Brunei dollar against Malaysian ringgit. So what they have to do, if you want to appreciate, if the government wants to appreciate, make Brunei dollar more strong. If you want to make Brunei dollar more strong, government of Brunei will make sure that BND is not available in market, meaning that the supply of BND will reduce. So in order to make Brunei dollar strong, what you can do, make sure that Brunei dollar is not available in market. So anything that has less supply, obviously price will go up, right? So it will be appreciated. So government of Brunei will make sure that there is a shortage going on with Brunei dollar. If there is a shortage going on, then foreign investors who want to invest in this country, they will have to wait, or they will have to pay higher price in order to get the Brunei dollar. So that higher price will appreciate Brunei dollar against Malaysian ringgit. So that is the way indirectly government can control the foreign exchange market. But government does not want to directly do it because government is not actually directly part of financial market, but government controls currency market because currency market is quite sensitive and it influences your value in the short and in the long run. Okay, so I have discussed about 5 points. These are actually the basics. Okay, if you understand these 5 points, these are the basics. and obviously the other points that roughly we are going to discuss about, these will eventually be connected to demand and supply and the and the 5 factors that we have discussed just now. Let's move on. Currency value, since remember it's a balance, it's an equilibrium price, right? Currency value is a balance price of currency. So therefore, in order to and also I said that currency value is for two currency, it is the two sides of the same coin. Okay, two sides of the same coin. So if one value goes up, the other value automatically goes down. It's the two sides of the same coin. So in order for in order to understand the value of the currency, how it changes, we need to understand two major factors. Actually, these are two sides of the same coin. One is the arbitrage and the other one is parity. Arbitrage and parity. So I'm sure that you know about arbitrage and parity. You have heard about this term before. Now, what is an arbitrage? Now, arbitrage is the profit earned without taking any risk, often by making profit from the differences in the market. So arbitrage is the profit that you earn by simply taking advantage from the market. There's some discrepancy going on in the market. You are a very clever person. You are a resourceful person. You take the advantage of the market and make some profit. That's called arbitrage profit. Okay, what is a parity? Parity is opposite to arbitrage, or at least the result, the consequence of arbitrage. So when there is an arbitrage, there will be some consequence, right? What is the consequence? When there is an arbitrage, somebody is increasing, somebody is getting more profit. Okay, they are not taking any risk, but they are getting profit. So more and more people will get to know that there is an arbitrage, right? There is additional profit. So by doing something, you are making extra profit. Many more people will know about it. What will happen? That profit will be vanished, okay, within very short period of time. So it means that market will adjust with the arbitrage, right? So when there is an arbitrage, then market demand and supply function will move towards certain direction, that somebody is earning more profit by doing something and many people will know about it. So the arbitrage will automatically be vanished after some time. When the arbitrage vanishes, that condition is called parity condition, meaning that the conditions are now stable. Nobody cannot earn any profit. So the arbitrage is often considered as arbitrage is the imbalance between demand and supply. Parity is the balance between demand and supply. Okay. Say, for example, you suddenly hear from someone that there is a product being sold at a very low price. Okay, you get this information, private information, that some products are being sold at a very low price. Okay, lower than market. What you will do? You will buy that product because market price is high. You will sell at a higher price and will make arbitrage profit. But more and more people will gradually know about that opportunity. Okay. I'll give you an example. There is a famous Brazilian shoemaker, famous Brazilian shoemaker. They use original leather in their shoes, and only few people, even 3 years ago, only few people knew in Brunei that this Brazilian shoemaker is actually selling shoes in Huaho. In every Huaho, there's a shoe shop that is selling that Brazilian company shoe. They also buy leather shoes from Colombia and sell in the same shop. So this is an arbitrage information. Many people didn't know about it, right? So what you are doing, basically, because of this information, you capitalize on that information, and you're buying good shoes at a very less price. Okay, now as a businessman, you can do some business. You can buy good shoes at a low price and can sell it at a high price because the shoe quality is very good. So this is arbitrage profit that you were making because of imbalance in the market, right? But more and more people came to know about it. More and more people started asking, hey, where he is getting all these good shoes at a very low price. And people are started searching for this information. And they found out that, well, there is a Brazilian shoemaker is selling these shoes to Huaho. So when more people know about it, they start searching for this and they start capitalizing on the same information, right? When many more people started buying the same Brazilian shoe, the price of Brazilian shoe will increase, right? If the price of Brazilian shoe increases, the arbitrage opportunity is gone, meaning that the demand and supply function now is balanced and there is a parity. Okay. Previously, there was a disparity. Because of disparity, there was a disequilibrium. Now, because of parity, everybody knows about the same information and there is no additional return to anyone. So always remember, arbitrage and parity, these are two different sides of the same coin. If there is an arbitrage in the foreign currency market, there is no parity. And if there is no parity, currency market will be always unstable. Okay, but today or tomorrow, there will be parity in the market, even if it is for a short period of time. And if there is a parity, you will see that currency value will reach its equilibrium. This equilibrium is parity, meaning that there is a negotiation between demand and supply. But if the equilibrium is not reached, meaning that somebody is always controlling the supply or they are controlling the demand, meaning that they are earning some additional return and the market offers them arbitrage. Arbitrage can be earned in many ways. There are many different types of arbitrage available. There are three major types that we often discuss in currency market. I'll give you some example just to understand. You don't need to take them seriously, but you need to understand them. That's the important thing. Locational arbitrage is the difference in the rates in two locations. So you can buy from one location, can sell it in another location. For example, a kilo of rice, in Kuala Belait is selling at, for example, $1. The same kilo of rice, same rice, okay, same rice, no difference in quality. The same rice is selling in Bandar, for example, in BSB at $5. So there is a difference between the rates in two different locations, right? So after adjusting for transportation cost, if you can bring the same rice from Kuala Belait to Bandar, you will be making a huge amount of profit, right? So that's called locational arbitrage. But then again, locational arbitrage also will not sustain for a long period of time because many people will know about this opportunity and big shot like Huaho and others will take up your opportunity and you will lose that opportunity. Next one is triangular arbitrage. Triangular arbitrage is the difference between actual cross and calculated cross. I'll give you an example. What is a cross rate? I'll give you an example of cross rate. So if the cross rates are different, then there is a possibility of arbitrage. And if there is a possibility of arbitrage, exchange rate calculation will be difficult. Third one is covered interest rate. Covered interest rate arbitrage. Covered interest arbitrage, they call it CIA. Covered interest arbitrage is the difference between actual and calculated forward rates, okay, with the difference with interest rate. I'll give you example of each of these so that you understand. Now, theoretically, arbitrage stays between markets where the law of one price does not hold. meaning that law of one price basically says that the market has a parity. So I will give you example now on law of one price, then I will explain parity and arbitrage again. Then we'll move to types of arbitrage. Let's give you an example of law of one price. Now, what is the law of one price? Prices of identical products in two locations will be same. Okay, prices of identical products in two locations will be same. In two different scenario will be same. For example, one color pen. Okay, one color pen in ringgit, for example, is 3 ringgit, RM3. Okay, it's a color pen, 3 ringgit in Malaysia. Okay, and the same color pen, same company, for example, in Brunei dollar is B$1. Okay, these are the prices given. Now, apparently, looking at the prices itself, you can think that, oh, these are not law of one price, because the currency values are different, right? One is 3 ringgit, the other one is Brunei dollar 1. Now, because these are two different currencies, right? Two different places. So now you have to adjust for currency value, right? So what is the currency value? Currency value is RM3 divided by B$1, right? So the value of the currency between ringgit and Brunei dollar is what? It's 3:1. Okay, currently, roughly, what is the average ringgit to Brunei dollar? Is 3:1, right? Is three ringgit spent for 1 Brunei dollar or 1 Singapore dollar, right? So this is the basic adjustment for currency value. Now, after adjusting, if real currency value is 3:1, then there is a parity in the market. Okay, if there is the real currency value is also 3:1, that means there is a parity in the market. There is a law of one price. Law of one price holds. This theory holds, meaning that the calculated exchange rate and the actual exchange rate is same. Adjusted currency value and the actual currency value is same. If these are not same, for example, if currency value is 4, there will be benefits for some people, either for buyer of the pen or for seller of the pen. Okay, you can now determine who is going to get benefit. Now, if it is 4 ringgit to 1, 4 ringgit to 1, meaning that you can actually buy 4 ringgit with Brunei dollar 1, right? Meaning that Malaysian ringgit is now weaker. Malaysian ringgit is weak in considering the Brunei dollar. What you can do is you can buy more pen from Malaysia. You can buy more pen from Malaysia because you can buy more ringgit at a lesser Brunei dollar. Okay, and you can bring them to Brunei and sell it at $1. Okay, it is still $1 in Brunei, right? But it is much lesser than the value of $1 in Malaysia. In Malaysia, you can actually buy 4 ringgit for 1 Bruneian dollar. If you can buy 4 ringgit, you can buy more pen, much more pen with your Brunei dollar in Malaysia. So if you can buy more pen from Malaysia, bring it to Brunei and sell it at $1, you'll make 33% extra profit, keeping other thing constant. It is just across the border. So if the currency value is 4:1, or the other way, if the prices are different and it's not adjusted for the currency value, then there is an arbitrage. meaning that either the buyer or the seller will make some extra benefit, okay, in any of the markets. Now, in order to bring to parity, in order to go to a parity, what the market has to do, if the currency value is actually 4-1, to bring parity in the market, to adjust 4-1 from 3-1, right? Previously it was 3-1, now it is 4-1. So market has to adjust, right? If the market doesn't adjust, there is an arbitrage, and arbitrage cannot sustain for a long time because people will know about it. There are a lot of smart people in Brunei, you know, they will go to MIDI and they will buy the pen at a lower price and bring it to Brunei to sell at a higher price. So if a lot of people knows about it, so demand for Malaysian ringgit will increase, right? If the demand increases, at some point, the prices will go back to RM3, right? If the Malaysian ringgit demand increases, Malaysian ringgit will appreciate, right? So it will appreciate from ringgit 4 to ringgit 3. You need lesser ringgit now to buy the same Bruneian dollar. So that's how parity, in order to bring parity, you have to adjust the currency value. And when the currency value go back to 3, when currency value appreciates to RM3, the value adjusts to 3-1, right? So value goes back to 3-1 because demand and supply function in the market adjust the price from 4-1 back to 3-1. So parity is very strong. Parity is a very strong force in the market. Law of one price is a very strong force in the market. At the same time, arbitrage is also strong. If there is no arbitrage, you can see now from here, if there is arbitrage, market will move. Market will move. Demand and supply function will move. If there is no arbitrage in the market, market is kind of like lazy market, you know, it's not good for traders. In any good market for traders, there has to be significant amount of arbitrage. So I'll give you some example now. You can now understand what is the parity condition in order to match the value of the same product in two different currencies. The currency value must be adjusted, right? Currency value must be adjusted. I'll just leave one statement here. It means using parity condition, we can actually forecast the value of currency, right? How? We need to identify the factor that changes value of currency from 3-1 to 4-1, right? So we just need to understand how the currency value changes from 3-1 previously to 4-1, or the other way, how the currency value changes from 4-1 to 3-1. If you understand this difference or transformation, you will understand how you can forecast currency value with Malaysian ringgit and Brunei dollar, right? We will. This is based on price. So I will give you more example in the later chapter how to do that. Okay, how to use the parity condition to forecast the prices of currency. That is one of the objective of this chapter. So international arbitrage, there are 3 arbitrage, as we say. We'll take 1 or 2 example and then we'll go for a break. Okay, we'll go for a small break. So first one is locational arbitrage. As I told you before, this is additional profit earned because of differences of prices in 2 different markets or 2 different places, right? So just now I give you an example of MIDI and Brunei for the same pen. So you can actually get into same country as well. Say for example, there are 2 banks here, Bank C and Bank D. In Bank C, the New Zealand dollar bidding price is the purchase price. You can write it down somewhere. Bidding price is the purchase price. Ask price is the selling price. Okay, so selling price will be higher than purchase price. So in New Zealand dollar, Bank C, in bank C, they are selling at 0.640 per dollar. Okay, 0.640, and purchase price is 0.635. Okay, and New Zealand dollar in bank D, another location, they are selling at 0.650 and they are purchasing at 0.645. So if the same currency in nearby location, keeping other thing constant, the prices are different. What you can do, you can buy and sell, right? You can buy from another bank and sell it in another bank. So how you are going to do it? How you are going to do it? The strategy is written here. Buy New Zealand dollar from bank C. Okay, you will buy at 0.640 because this is your buying price and this is the selling price of the bank. So bank will sell, you will buy. Okay, your buying price is bank's selling price. So you are buying at 0.640 and then sell it in bank D, okay, at 0.645. Your selling price is bank's buying price, right? Okay, you are selling at 0.645. What is the profit? The profit is the difference between these two, is $0.005. So by taking the advantage of the differences in the market prices in two different locations, we can kind of like establish arbitrage. Now, is it going to sustain for a long period of time? Now you should know that it's not going to sustain for a long period of time. Why? Because many people will know about it, right? They will know about it. Oh, okay, these people are getting extra amount of money because Bank D is offering higher price, So they will all move to Bank D. They will all do the same thing. And when they all do the same thing, all the customers, all the investors start moving to Bank D. Okay, they buy from Bank C and they sell in Bank D. When they are buying from Bank C, okay, the buying pressure, too much of buying pressure in Bank C will increase the ask price, right? Will increase the ask price. This ask price will be higher and it will match with 645. If it goes to 645, then there is no arbitrage profit. Okay, so demand and supply function will bring the market to parity again. So there is locational arbitrage. Let us go to now international arbitrage. Triangular arbitrage. Triangular arbitrage. In triangular arbitrage, the main issue is cross exchange rate. Cross exchange rate. I will show you an example of cross exchange rate. But can we take a break for, let's say, 10-15 minutes? 10-15 minutes. We'll take a break. Many of you are, I'm still sleepy. Need to have a coffee. So let's come back around 9:50. We can come back at 9:50, 9:50. Okay, we take a 15 minutes break. 9:50. We'll come back and we'll continue with cross exchange rate and international arbitrage. Okay, everyone, welcome back. So we are talking about arbitrage, international arbitrage, and we discussed about locational arbitrage, that there is difference between locational rates in two different locations, and we can take the advantage and make some extra benefit. But that benefit will not sustain for long because of the parity condition, right? So the opposite to arbitrage is parity. Now we'll show you triangular arbitrage. And to show you triangular arbitrage, I need to take you to a real life example. Then I'll come back to this example again. Okay, real life example. Let me take you to a website that I have suggested for you, xe.com. So in xe.com, you can, look at the currency rates, the running currency rates and others. Yeah? You can convert and also look into the current rates that are going on. So, for example, this is the the currency rate going on against Singapore dollar right now. So Singapore dollar 1 equals US dollar 0.74, and Malaysian ringgit is 3.0798. So and these are the change. So the rate dropped by 0.14%. You can also click the charts here in order to see the trend. And you can see at the right corner here, this basically says that every 10-15 minutes, seconds, this rate will update. It's a real-time information. So you see after update, it's 60 seconds. So every 1 minute it will update. You see after updating, the Malaysian ringgit has changed from 3.07 to 3.08. So it's a real-time update happening. So now what we have is we can see the rates for multiple currencies and can also look into the rates, okay, rates against one currency. So let's say for Singapore dollar, the US dollar rate is 0.74. So I'll write it down somewhere so that I don't lose the value. So let me take you to the Excel file. So cross exchange rate. So currently I'm thinking about what Singapore dollar, right? So the Sing dollar 1 is for USD 0.74. Okay, 74277. And the Malaysian ringgit is RM 3.0804. Okay. And I can also get the same rate for the other currencies. For example, I can get what is US dollar 1 equal Singapore dollar, or I can also get what is the US dollar currency to Malaysian ringgit rate. So let me get this and I'll come back to it again. Say, for example, I want to get the US dollar to Malaysian ringgit. Okay, so Malaysian ringgit to US dollar. Oh, that's a lot of money. Okay, $1, one Malaysian ringgit. Now Malaysian ringgit becomes my primary currency, right? And I can look at it in a comparison. Sorry, where is it? Oh, here it is. So the Malaysian ringgit to US dollar is 0.24111. Okay, so let's take until this. So this is 1 Malaysian ringgit. 1 Malaysian ringgit equals USD 0.24111. Okay, so we can also get another, no need, we have all the information that what we need. So now what we can do is, these are the triangulation of currencies. Now let me explain it to you how it works. It's a triangular of currency, right? There are three currencies here. What are the currencies here? One is Singapore dollar. Okay. The other one is US dollar, US and dollar sign. And the other one is Malaysian ringgit, right? Ringgit Malaysia. Now, based on this triangulation, you see there is a triangulation happening. So each of these currency, for example, Singapore dollar has a rate for US dollar, right? US dollar has a rate for Malaysian ringgit. Malaysian ringgit has a rate for Singapore dollar, right? Now I can convert the remaining two currencies to one single currency. For example, you can convert, we take a different color, you can convert ringgit to Singapore dollar, US dollar to Singapore dollar. You can represent all currencies to Singapore dollar. That's what we have done here. Singapore dollar 1 equals US dollar 0.74. Singapore dollar 1 equals ringgit 3.08, right? Now, interesting fact is you can use this US dollar figure and ringgit figure. You can divide them or multiply them, and you can get to this one. Okay, the relationship between ringgit and USD. Okay, the relationship between ringgit and USD, you see here is ringgit and here is USD, right? These two currency can have calculated cross rate. Remember cross rate? Calculated cross rate based on their relationship with a single currency, Singapore dollar. Okay. Now the calculated cross, let me write it down, then you'll understand. Calculated cross of USD and ringgit Malaysia is, you can calculate based on Singapore dollar USD 0.74 and ringgit Malaysia is 3.08. Okay, so let me calculate it and show it to you. What is the cross exchange rate between these two? So this would be, give me some time, 3.08. Yeah, so 0.74277 divided by 3.0804, right? These are the two figures that we have from above calculation, above information. And what is the calculated cross of these two? Calculated cross would be 0.74277 divided by 3.0804. This would be 0.2411278, right? Now this is very close to this rate, you see, very close to this rate. This is basically Malaysian ringgit 1 to US dollar. This is in US dollar. Malaysian ringgit 1 to US dollar 0.2411278. Now, this is calculated cross. What is the actual cross? Actual cross, the information that we come from here. You see the actual cross rate is here, 0.24114435. It is changing, yeah, because of the time. So the actual, sorry. Now we write the actual cross. Actual cross equal 0.24111, right? So we have the actual cross and we have the calculated cross. Okay. Now the condition is if the actual cross and the calculated cross rates are different, there is an arbitrage. Okay, now you see that there is a minor difference here. You might be thinking how this can be beneficial. You know, very minor difference. 0.24112, 0.24111. There is a only at the fifth digit, after decimal point, fifth digit, there is a difference. Now, you might be thinking how it is beneficial. Let me show you how it is beneficial. If I take the inverse rate, okay, inverse rate, this current rate is in terms of Malaysian ringgit 1 equals dollar figure, right? So I inverse it. So if I inverse it, this would be like 1 divided by 0.24111. This would be 4.18. So let me show it to you. This inverse rate is 4.18. Sorry, 4.147. Let me take 3 digit. The calculated cross, the inverse rate, the opposite rate in opposite currency is the 1 divided by 0.24112. So this would be almost almost the same. So let me calculate again. 1 divided by 0.2411278. I take the entire figure. So this is almost the same. 147. 17 something. So, the difference is currently the difference is 0, right? So if the difference is adjusted and difference is 0, if the difference between the calculated and actual cross is 0, there is no arbitrage profit. So currently, since the market rate is changing, right? If you go back, you'll see that market rate is changing again. You see now it is 0.241137. So since the market rate is changing every 1 minute, it is adjusting. Demand and supply function is adjusting, and the price is also adjusting, meaning that this market does not have any arbitrage profit. So if there is no arbitrage profit, then obviously you are in a market where there is parity, right? So we take you to the example here again. In the PowerPoint slide, the example is given for British pound sterling. Their bid price, remember the purchase price, and the ask price is the selling price of the bank. The rates are given 1.60 in terms of dollar, 1.61. Malaysian ringgit is 0.200 dollar and 0.202. That is also in dollar, right? So you have the same currency representing two different currencies, British pound sterling and Malaysian ringgit, meaning that you can also have a cross rate. What is the cross rate? The pound sterling to Malaysian ringgit rate is 8.1 and 8.2. This is the actual cross. This is the actual cross. Okay. Let me check. Let me check. 1.6, the first one, divided by 0.200. So here, the first one, if you take the 1.60 divided by 0.20, the actual result would be 8.0. Okay, instead of 8.1. So the given cross rate is 8.1 and calculated cross rate is 8.0, meaning that there is a discrepancy in the market, right? This discrepancy, you might be thinking that only 1 cent. What is the benefit of 1 cent? When you are investing a huge amount of money, this 1 cent would be a bigger amount. So how they are taking the advantage? Buy pound sterling at 1.61, convert it to Malaysian ringgit, then sell Malaysian ringgit to dollar. The profit is 0.01 per pound sterling. So I have directly calculated that the difference, there is a difference between 8.1 and 8.0 that will give some additional benefit to somebody, and the additional benefit, how you can get it by using this strategy. So as long as there is an arbitrage in the market, that will influence the price and that will push the price towards parity. The third one is a little bit complex to understand, but we will make it easy for you. Covered interest arbitrage. Covered interest arbitrage. Now the question is why interest is coming here? Why interest rate is coming here? Let me give you an example. covered interest arbitrage. Okay, now remember that you can invest in other countries, right? So you can invest in Singapore. Say, for example, you are investing in Singapore. So current rate is the, let's say, Malaysian ringgit. So RM 3.05 equals Sing dollar 1, right? This is the rate, current rate. Okay. And interest rate in Malaysia is, for example, 3%. Okay. And interest rate, sorry, in Singapore, for example, is 1%. Okay, so this is what is the condition given to you. Now, when you look at it, what do you think? What do you normally think? That there is a possibility that you might be able to bring money from Singapore. Okay, you can borrow from Singapore and you can invest in Malaysia, right? Because Malaysian interest rate is high, right? So you can borrow from Singapore at 1% rate and you can convert it to Malaysia and invest in Malaysian market, right? At 3% rate, because Malaysian interest rate is higher. And let's say these interest rates are for 3 months. Okay. Now after 3 months, what you will do? So you will borrow today from Singapore. You will convert it to Malaysian ringgit and you will invest it in Malaysia for 3 months. Okay. After 3 months, you will convert it back to Singapore dollar, right? Your company is in Singapore. So you will convert it back to Singapore dollar. Now, if the future rate after 3 months, right, is not adjusted for the interest rate change. Remember, interest rate change between two countries is 2%, right? Interest rate change is 2% between two countries, 3% and 1%. So if the future rate after 3 months, future exchange rate after 3 months is not adjusted for the interest rate change, there is arbitrage. So some people can make extra amount of money if the exchange rate is not adjusted for the interest rate change. Roughly, the exchange rate should be adjusted for 2%. Okay, more or less 2%. Okay, so if it is less or high, if it is not 2% adjusted, then there is a possibility of arbitrage. Okay, so based on this is called covered interest arbitrage. Okay, we will take you now to an example and see how it goes. The covered interest arbitrage tend to force a relationship between forward rate. Forward rate is the rate in the future, right? Forward rate premium. What is the increase or decrease in forward rate? Meaning that what is the difference between rate in the future, F, and rate today, spot rate. Remember spot rate and forward rate? So the difference between these two must be exactly same as the interest rate differential, right? Changes in interest rate, delta I, changes in interest rate is what? The example that we have given is 2%, right? So the difference between forward rate and spot rate should be exactly 2%. If these two differences are not same, then some people from Malaysia or Singapore can invest in either countries and can make additional benefit. So if these two are not covered, you know why they call it covered interest arbitrage? Why it is not covered, or why it is covered? Because the forward premium, okay, the future rate, the extra rate that you get from the spot rate, forward premium should be exactly same as this 2%. If it is not covered, if it is not the same, then there is a covered interest arbitrage. We take an example here. I leave this example for you. I give you the strategy already. You can do it at home and see how it goes. The spot rate is 1.60 for pound sterling. A 90-day forward rate is given. Future rate is given 1.5692. This is the 90 days, 3 months forward rate. US 90-day interest rate is given 2%. UK 90-day interest rate is given 4%. And the investment that you can do is $800,000. You have this money in cash, you can invest it. And as we know already, since the interest rate difference is 2%, right? Interest rate difference is 2%. The forward and the spot rate difference should be also 2%, right? If these two are not 2%, there is a possibility of arbitrage. So you can calculate it, whether there is an arbitrage or not. How you can do it? Convert pound sterling at spot rate to invest in dollar for 90 days. Reconvert the dollar after 90 days using the forward rate and calculate the return. Yield is return. Calculate the return. If the return is positive, there is an arbitrage return. If the return is not positive, meaning that market has already adjusted, so there is no arbitrage benefit. So from arbitrage, what we have learned so far? From arbitrage, what we have learned so far, that market will have differences between demand and supply at certain point in time, and the market will recover it, right? If the market is good, it will automatically recover the differences. And the recovery process in the market, we call it parity function, right? Parity function. We'll take you now through a number of examples how this parity function can be used to forecast the currency value in the future. Okay, so arbitrage does not stay for long as it triggers demand and supply function to change market prices, right? So rate will come to parity again. So it will take some time. In good market, it happens very quickly. In less structured market, less developed market, the parity function takes some time, but it will eventually come to parity, right? So the three major factors based on arbitrage, three major factors that drive the rates of currency are the general price level, inflation rate, and interest rate. We'll give you now examples on how we can use these parity conditions to calculate the future exchange rate. First one is price. Okay, I have already given you an example of pen, right? Pen. I've given you the example of pen. Where is it? The pen, the color pen example. The color pen example is the example of the price-based exchange rate. I don't want to go into details about this. These are some economics topic as well. The price-based forecasting of exchange rate is based on a concept called purchasing power parity, right? PPP. So that is exactly the example I've given previously. If the, in order for the price of the same color pen in two different market, in order for this to be same, after conversion, it must be adjusted for currency value, right? So the purchasing power, your purchasing power of 3 ringgit, your Brunei purchasing power of $1, this must be in parity, okay? Purchasing power parity if it is adjusted for currency value. Okay, so now at 3:1, currency value 3:1, these product prices in two different locations are in parity. So there is a parity, purchasing power parity, because it is adjusted for currency value. But if the currency value is different, okay, there will be disparity. There will be disequilibrium. Now let us look into the disequilibrium. There is a nice example here. You can look at it. This is the price of, I think, Big Mac. Yeah, I think you have taken Big Mac already, purchased Big Mac from McDonald's, right? So Big Mac is available, I think, in over 150 countries, if I'm not mistaken, 150 countries, and it is quite identical product in different countries. So what they have done here is they try to calculate what is the US dollar rate for a Big Mac? What is the Britain rate for a Big Mac? And they try to calculate whether the purchasing, what is the difference in purchasing power in two different countries. If the purchasing powers are adjusted for the currency value, then the under and over valuation, you see, under and over valuation would be 0%. 0%. If the difference in purchasing power, like the pen example, is not adjusted for the currency rate, there will be appreciation or depreciation. You see, some of the currencies are highly depreciated against US dollar, and some currencies are only 3% or 8%, 10%, 42% in China. So in China, the US dollar value is, the Chinese currency value is 42% undervalued compared to the US dollar. So this is a nice example. This has been taken as Big Mac index, the Big Mac index, and this has been I think referred in business school as a practice of law of one price. So we now look into the prices, right? We are looking into prices. So PPP, purchasing power parity theory, suggests that a relative difference between changes in price between two countries for identical product. Remember the pen example we have given. So what is the changes in price in two countries, for the identical product, should help estimate the exchange rate between the said country, right? For example, now if the currency value change, if the price changes, for example, from 3 ringgit, let's say the price goes up to 4 ringgit. Okay, 4 ringgit. So if the price goes up to 4 ringgit, then the currency value must change, right? This currency value from 3 to 1, it must be 4 to 1 if there is no other product in the market, right? So the currency value will change. Currency value will change based on the change in purchasing power parity, right? Based on the change in purchasing power. That's what purchasing power parity theory is trying to say, that the changes in prices will help us to estimate the currency rate. How it will help? Using this equation. Okay, using this equation. What is the equation here? Percentage change in foreign currency. Percentage change in foreign currency can be estimated based on changes in price. Remember, what is the indication for changes in price? Is the inflation rate, right? So 1 plus inflation rate in the home currency divided by 1 plus inflation rate in the foreign currency minus 1. This will give you the percentage change in price. Percentage change in price. So you would be able to forecast what would be the forecasted exchange rate based on this equation. I'll give you an example, then we'll move to the another parity equation. Let me give you an example. Let's say the inflation rate or price change, right? Inflation rate in two currency, let's say ringgit is 2%, and 2%, and let's say in Singapore, Singapore dollar is for inflation rate is okay. Let's 3%, and 2%. Okay, Singapore is 2%, Malaysia is 3%, right? Now the current rate would be what? Current rate is, for example, 3 to 1, right? So this would be Malaysian ringgit 3.08 to Sing dollar 1, right? This is the current rate. So if the inflation rate is given, you can actually calculate what is the percentage change because of the inflation rate changing, because of the price changing, right? Inflation rate change means the price is changing, your purchasing power is changing. So if your purchasing power changes, you can now estimate what should be the exchange rate for these two currency, right? So how you can do it? Remember, EF percentage from the equation is inflation rate home divided by inflation rate foreign. Always remember, inflation rate home is high at the numerator, and inflation rate foreign at the denominator. So how we can do it? 1 plus the inflation rate home. Let's say I consider Malaysia as the home. Okay, Malaysia as the home. So home currency inflation rate is 3%. So 1 plus 3% divided by 1 plus the foreign country is Singapore, for example. Singapore is 2%. Okay, so close them with brackets, minus 1. Close them with brackets, minus 1. That's a lot of figure. Let me reduce it in size. Sorry. Okay. So roughly what? Roughly 1%, right? Roughly 0.98%. So the changes in this EF percentage means the foreign currency rate will change by 0.98%, right? Will change. Now, this change is not enough. You need to find out which one is increasing and which one is decreasing. And remember, our theory says higher inflation rate, currency will depreciate, right? Will depreciate. So that means the currency with the higher inflation rate will depreciate by 0.98%, meaning that the Malaysian ringgit will depreciate by 0.98% because the Malaysian ringgit inflation rate is high. Their inflation rate is 2%, and Singapore inflation rate is Malaysian ringgit is 3%, Singapore is 2%. So because of higher inflation rate, their currency value will drop by 0.98%. So how it will drop? So currently the value is 3.08. So it will increase by 0.98%. So let me calculate the future price. F equals S multiplied by 1 plus EF, right? EF percentage. So this is the equation that we use to calculate the forward rate, the future rate or future spot rate. So how we calculate the F here? In order to calculate the F, we need the S, spot rate. Spot rate is 3.08, remember? So multiplied by, we need to increase the value, right? This will depreciate, meaning that you need more Malaysian ringgit. You need more Malaysian ringgit to purchase the same Singapore dollar. So 1.098. Okay, it will increase, 0.98%. So this should be 1.0098. Yeah, 0098. So the new currency value is 3.11. So after the changes in price, okay, meaning that inflation rate, after the changes in inflation rate, we need ringgit 3.11 to get same Singapore dollar. Okay, previously we needed 3.08. Now we need 3.11. We need more Malaysian ringgit to get the same Singapore dollar because Malaysian ringgit is suffering from inflation rate, higher inflation rate. There is a graphical representation here. You can look at it. You see the difference here: home inflation rate minus foreign inflation rate, right? So if the home inflation rate is high, your inflation rate is high, you will have increased purchasing power of the foreign goods. Okay, meaning that your products will be expensive, foreign goods will be cheaper. If your inflation rate is high, your purchasing power will drop, your products will be expensive, but foreign products will be less expensive. But if it is opposite, then you will have decreasing purchasing power of the foreign goods, meaning that if the foreign inflation rate is high, the foreign goods will be more expensive, your local goods will be less expensive. So inflation rate will eventually determine whether your currency will be appreciated or depreciated. If your currency appreciates, your purchasing power will increase. If your currency depreciates, your purchasing power will drop. If your currency appreciates, your purchasing power goes up, you can buy more foreign product. If your purchasing power drops, you cannot buy foreign products. So based on whether you can buy or not, whether you can buy foreign products or not, based on that condition, your purchasing power, your exchange rate will be calculated. Another way of calculation is looking into interest rate. Remember, we told you that interest rate is connected to inflation rate, right? So we go straight to the interest rate parity. The second one is interest rate parity theory. Concept is same. Concept is exactly same. Just only the equation figure is different. Okay. Instead of capital letter I, we use small letter I to denote interest rate. The equation is exactly the same thing. Okay. So we represent this in terms of P. P is the forward premium. Okay, forward premium or discount is calculated. That means that this P is the difference between forward rate, okay, and the spot rate. P is the difference between forward rate or future rate and the spot rate, current rate and the future rate. So what is the difference? The difference is percentage of P. This is in percentage, 1 plus interest rate home divided by 1 plus interest rate foreign minus 1. The implication is exactly the same. Implication is exactly the same. If instead of here, for example, we calculated EF percentage, right? In interest rate, we'll calculate P. And P will be calculated same way, and interpretation will be same. So we know that if the borrowing cost is high, the country will suffer and their currency value will depreciate. Okay, so the graphical representation is here. If the home interest rate is high, home interest rate high, foreign interest rate, okay? If the home interest rate is high, this is the zone of potential cover interest by foreign investor. So if your home interest rate is high, many foreign investors will come to your country to invest, right? But if the foreign interest rate is high, many local investors will bring the money outside to invest in foreign country. Okay, so that's the way the arbitrage, the purchasing power parity, and also the interest rate parity theory works. What I want from you from this entire discussion, what I want from you that you remember these two equations. One equation is this one, how to calculate the percentage change, okay, based on inflation rate, and how to calculate the percentage change based on interest rate. The equation is same, the concept is same, the implications are all same, it's just that two different figures. If you remember this equation, you would be able to calculate future exchange rate based on inflation rate or interest rate, whatever figure is given. And at the end of this chapter, there is an example given here. There's an example given here. Malaysian ringgit to USD rate is given. That was long time ago, I think 2014 or 15 rate. Inflation rate in Malaysia is given in different year, 2%, 3%, 4%, 5%, okay? And the inflation rate in the USD is same, 2%, 2%, 4%, 4%. So depending on the changes, lateral changes, 2% to 2%, 2% to 3%, 4% to 4%, 5% to 4%, you can calculate using the inflation theory, right? Using the EF percentage. Just now we have done purchasing power parity theory, right? So using the EF percentage, you can calculate what should be the future exchange rate in year 1, year 2, year 3, right? You can calculate the future exchange rate. Okay, now we give you some more very brief example on how to forecast exchange rate and what are the factors that we consider very briefly, because forecasting exchange rate is a huge phenomena. We cannot simplify this into very small, class time or something you want to say. It's kind of like one course, one course. So it's very difficult to conceptualize. So we'll try to very briefly cover. So let's look into this. These are the Malaysian ringgit to USD rates. First one is over 1 year period. Second one is over 5 year period. Third one is over 10 year period. Now, why I'm showing all this, because you can see what is the volatility in 1 year, okay, how the rates are going. What is the volatility in 5 years time, okay, and what is the volatility in 10-year period, okay. So you can see that over the long period of time, volatility is generally very low. Okay, over the short period of time, the currency rates or any prices are more volatile, right? You can go to xc.com. Just now we have shown you in order to get more information on more currencies. So what are the factors that we look into in order to calculate the forecasted rates? Okay, let me take you to the chart. It will be easy for you. There are three major factor conditions. First one is the parity condition. Just now we have given example of parity condition. We can use inflation rate, we can use interest rate, okay, and forward exchange rate. We can also look into forward market, the derivative market, forward market, to look into the exchange rate, and also parity theories, the purchasing power parity, and also the interest rate parity to understand what should be the future exchange rate, right? So this is the parity condition. We have already taken example. In the previous one of the classes, remember I told you some examples about balance of payment, right? BOP can be used to also forecast future exchange rate, right? BOP gives you the economic condition of the entire country, right? So if that is a condition, then BOP also can help you to estimate your future exchange rate, right? So current account balance, remember the export-import function, current account balance, portfolio investment, foreign direct investment, capital account, financial account, that can help you to understand the future exchange rate. The other one is the asset market approach, the more fundamental approach, asset market approach. There are speculation here too. So let's look into some of these factors that you can use to forecast exchange rate. You can look into relative real interest rate in the market and use the same equation. Remember the interest rate parity theory, can use the same equation, or you can run a regression function to calculate. Prospect of economic growth, you can take GDP, for example, GDP, and look into the regression model to see what is the forecasted exchange rate, right? Supply and demand for asset, okay, main asset. Let's say your country is famous for oil and gas, right? So your oil and gas export and import will have significant impact on currency exchange rate, okay? Because this is your main asset. So depending on your main asset, you'll be able to forecast your currency rate, okay? Outlook for political stability. If your country is not politically stable, then you will have problems with your exchange rate, because investors will go out of your country, and when they are going out, they are actually going out with foreign currency, right? So your demand for your currency will go down, and automatically your currency value will drop. Speculation and liquidity, as I said, that speculation will move the prices towards certain direction. So you can look into investor sentiment. They call it sentiment, investor sentiment. And currency market also has investor sentiment. And based on investor sentiment, you can forecast which direction the currency value is going. Next one is political risk and control. Political risk and control related to kind of like that may have influence on currency value. We will discuss actually about political risk in one of the chapters. In I think the last chapter we'll discuss about political risk. So these are the factors that we look into when we develop a model. We develop a model in order to forecast future exchange rate. And there are examples given, details given for each of these here. I don't want to go through this. Okay, you will go through this to understand what are each of these factors mean. There are two ways we can actually calculate. One is what are the factors you consider, and the other one is what are the method. What are the method that you apply? There are two methods. One method is technical analysis. Okay, analysis method. One is technical analysis. Technical analysis is basically to use short-term information to forecast exchange rate. Short-term, the short-term information, for example, past price. Okay, so how do you do that in technical? For example, you write a regression equation like this, that the future exchange rate F, okay, F is a function of spot rate, current spot rate. So this is basically using the past price, using the current price to to estimate the future, right? So that is basically a technical analysis. In a technical analysis, our objective is to use the past prices, the currency rate in the last week, currency rate in the last month to forecast the currency value next week. Okay, so you can for example put an equation like this: currency value in week 2 will be or is a function of currency value in week 1, right? So you can use the past information, week 1 currency value, to look into the currency value in week 2, right? So the past prices should help you to forecast the future prices. That is what is called technical analysis. Technical analysis. Okay, the second one is the fundamental analysis. Fundamental analysis is more long-term in nature, and it considers fundamental information. It does not consider past prices. It considers fundamental information. Those have more long-term impact on the currency rate. These are like interest rate. You can use economic growth, GDP, capital market liquidity, country's economic and social infrastructure, and things like that. So you can use this information to forecast the exchange rate for the future. I have given a case study here for Asian crisis, how the Asian currencies, during the Asian financial crisis, they dropped in value. You can look at each of these currencies, how they dropped in value significantly during 1997. You see, 1997 financial crisis. You can go through this case and can get some information about how actually managers could not control the currency value in ASEAN region. You see, these are Philippine peso, Thai baht, Malaysian ringgit, and Indonesian rupee. Okay, so what are the exchange rate management system in practice? In practice, there are managers using different techniques to forecast exchange rate. Some of these are for short-term forecasting, some are for long-term forecasting. If you want to forecast a fixed rate, there are different techniques you use. Okay, if you are forecasting floating rate, you'll use different technique, forecasting method, right? So for long-term also, if it is fixed rate forecasting, you will use different technique, and for floating rate also, you will use different technique. Sorry. So there are different techniques available for long-term and short-term forecasting based on the floating rate and fixed rate exchange rate. So whichever exchange rate you are going to forecast, you can follow this slide and consider those variables for forecasting exchange rate in the future. Now, exchange rate forecasting is not 100% accurate. Okay, it can be up and down. So there might be different trend. You can look into trend of exchange rate. You'll see that exchange rate forecasting cannot be 100% accurate. So there are different turns. They call it turn 1, turn 2. There are different turns, and these turning points are very difficult to estimate. And often the exchange rate may actually go within certain border. They call it upper boundary and lower boundary. You can draw the exchange rate and see over the time period, exchange rate is moving like a snake. They call it snake tunnel. They call it snake in a tunnel. So it's like, the snake is moving in a tunnel up and down within certain border. If you can form this kind of border, or the central bank can also establish certain border for their currency value, meaning that central bank indirectly controlling the currency price within certain range, right? What is the range here? Minus 1.75% to plus 1.75%. So currency value will move within this range. It will not go beyond this range. The moment it goes beyond this range, central bank will come to action, and they will try to take certain action to take the exchange rate back into the tunnel. You see, when the currency rate is outside of this tunnel, there is an intervention required by the central bank. And when the intervention is taken, the currency rate comes back into the tunnel again. So that's where the central bank buys and sells foreign currencies in order to control the value of their currency. How is the forecasting error for big investment banks, for example, JP Morgan Chase and others? These investment banks sometimes forecast the currency value because they are also doing international investments, right? So in order to satisfy clients, they need to offer forward rates and also future rates. So when they are offering, they need to forecast, right? Future exchange rate. And you see that even JP Morgan has significant error in their forecasting. They are so informative. They have so much of information. Still, the currency values are either low. Sometimes the currency values are high. What is this? Is this blue color or green color? Blue color, I think. The blue color one is actual spot rate, and the black color one is the 90 days forecast. So the currency value forecasted, but there is a massive gap. You can see that this is the error in forecasting. So there will be very limited chance that your forecasting error would be exactly 0, right? This is 1, meaning that forecasting error is actually 0. So there will be limited time when your forecasting error will be 0, but still you need to forecast, because without this forecasting, you will not be able to invest. So currency forecasting can be done using different models and different theories. So let me recap what we have done so far today. First, we have given you example on arbitrage, and we say that arbitrage is good for market, but for a short period of time. And when arbitrage is gone, market is in parity, it's in equilibrium. And market should be in parity if the market is good, market is behaving properly. But time and again, market goes out of parity, market goes into disequilibrium, and the demand and supply function will bring it back. Okay, so demand and supply functions are the major functions that control the prices. And there are 5 major factors that control this demand and supply for foreign currency. We discussed about changes in price or inflation rate, changes in interest rate, the economic growth, speculation, and also government control. These are the 5 major factors that can help us to understand the changes in the currency value. We have also talked about arbitrage, type of arbitrage. There are 3 major types of arbitrage: locational arbitrage, the covered interest arbitrage, and also triangular arbitrage. Each of these arbitrage give us information that there might be possibility that the exchange rate is not in parity. If the exchange rate is not in parity, some people will make additional money. That is not, in the long run, that is not good for the market. So the exchange rate has to adjust. Exchange rate has to adjust to bring the market to parity again. Then we discussed about at least 2 parities. One is the purchasing power parity theory, and we also discussed about interest rate parity theory. Both are conceptually the same, where we use the percentage change information to forecast the future exchange rate based on the inflation rate at home and also inflation rate in foreign. If you can remember this equation, I would be extremely happy, because this equation can be used to forecast exchange rate in the future. We have also talked about what are the other methods that we can use, what are the other factors that we can use. There are 3 major factors, right? One is the parity condition, the second one is the balance of payment approach, and the third one is the asset market approach. So these factors can be used in 2 different analyses. You can use it in technical analysis, or you can use it in fundamental analysis. And the technical analysis is using the past information, past prices and volume information to forecast the future prices. And the fundamental information is to use a broader set of data, broader set of information. Those are not past prices, to forecast the future exchange rate. And we have also talked about the practices, what are the tools and technique that managers used for short-term and long-term forecasting for fixed and floating rates. At the last, we discussed about forecasting error. We said that, well, forecasting will have error since you do not know the future 100% exactly. Therefore, future exchange rate will be different than your forecasted exchange rate. But we still need to forecast even though there are errors, because without forecasting, we cannot make any investment in foreign exchange market. Therefore, forecasting is the key. So the easy way to forecast for us now is to use the parity condition. Remember the equation that I've given, the E percentage or the P, where 1 plus inflation home divided by 1 plus inflation foreign minus 1 is the equation you should remember. Based on that equation, we can forecast future rates if the inflation rate or interest rate figures are given. And when you get the future exchange rate, you'll be able to make decisions for future. And that's what we have done today. And our main consideration was to understand the foreign currency rates. I think that's too much of information for today. We will not continue to any other classes today. We will continue to arbitrage and also how to reduce international risk in the next class. Even though we have 2 chapters for next class, actually most of our decision will be done in the first chapter, and we will have to do some calculations in the next class. So I will do the calculations, and you will follow me, or I will show you the calculation how it is done, and I will upload some solution for you to look into it. So we'll finish our discussion today here. If you have any question later on, you can raise it. These are interesting topics. Don't consider them as to, you know, like you have to memorize everything. Try to get them as interesting fact, because exchange rate is a everyday part of our life. You know, it's happening every day. We are buying things from online, you know, so we have to pay in foreign currencies, and therefore foreign currency is quite important fact. Sometimes we kind of like we avoid this fact. We can avoid safely because the individual level, you know, currency impact is very minimum. So it doesn't matter whether you know, the ultimate currency value changed from 3 ringgit to 3.50 ringgit for 1 Brunei dollar. You know, individual level, it doesn't make that much of difference. But when it comes to the corporate level, okay, corporate level, the difference is quite huge, and this difference can make one company go bankrupt. You know, so therefore we need to understand how forecasting is done using different models and factors. One last thing before we go. Nowadays, forecasting is actually done using something called data analytics. I think you heard about this, fintech and data analytics. I promised you that if everything was normal, I could have given you some information about fintech, but unfortunately, I couldn't, because you know, the lockdown came and everything. So the person who was supposed to give us the class on analytics, he used to be one of our friends from another department, but this guy is unavailable because of lockdown. So I pray that he's doing okay. But in any case, so our opportunities are very limited. But I will try to share some information with you, some guideline. Possibly my suggestion would be that in the future you will try to have some expertise, some skill on data analytics. At least if you can learn the software called Python, it's very easy. You guys are still energetic, you are young, so it would be very simple for you to learn. Try to learn at least one of the language software, like either R or Python. It will help you a lot in your career if you can identify that you can do data analytics, you can do profiling and visualization. It would be really helpful for you to get a job in better places. And it only takes, you know, a few weeks. I think it would be good for you if you can spend, you know, like 6 to 7 weeks to learn Python. It's coding, basically it's coding, and codings are very standardized coding, so you'll be able to easily learn software and application. That application you can use to forecast exchange rate, and the software or application is so powerful that it can give you very high frequency forecasting of currencies. So you can learn about fintech or financial analytics, how it can help you to forecast exchange rate. I'll try to upload some information in the later classes, but our priority now is to finish our regular chapters. Okay, so if you come up with anything, you can let me know. I will try to upload a case on international parity condition with possibly with solution. I will try to see whether I can get the solution. I will try to upload it on our Canvas. You can go through it. In the next class, we will do risk management. At least one of the risk management function we'll try to solve. That is the most important part. Transaction exposure, we call it, transaction exposure. So everyday transaction, import and export, how you manage the volatility of exchange rate. We'll try to see in the next class, and we'll try to have very brief discussion on other exposure as well, but main focus would be on transaction exposure. We'll give you a number of examples as well on transaction exposure in the next class, how to manage transaction exposure using different tools and techniques. So we'll finish it today here. All the best to you. Stay safe, and as usual, get vaccination and help your family members to recover from this problem. Stay with the elder and also with the young kids, and help them to understand the changes. You are more knowledgeable than them, and pray for me as well, whichever religion you follow. And we'll see you in the next class, inshallah. Thank you very much. Assalamu alaikum.